There is a moment that repeats itself in financial history, a moment when mathematics stops being an elegant abstraction and becomes violent reality. It is the instant leverage turns from a tool for building paper fortunes into a liquidation engine that destroys real wealth. In 1929, that moment erased 89% of the U.S. stock market's value in less than 3 years. People did not just lose numbers on a screen. They lost homes, jobs, and lives they believed would never change. It happened again in Japan in 1989, when the Nikkei collapsed and decades of prosperity vanished into what the Japanese later called the Lost Era, a generation that thought it had transcended cycles, discovered that cycles do not ask for permission. And in 2008, the world saw it again. The financial system, thought to be invincible, regulated, modeled, analyzed, came within hours of total shutdown. Every time, the people living inside the bubble claimed they were the exception. They said technology, policy, globalization, or new paradigms had made crashes obsolete. They were wrong, because what destroys markets is not a meteor, a war, or a conspiracy. It is mathematics, a 7-stage sequence triggered when credit, leverage, and optimism align. And in 2025, we are in stage 5, the same stage that in 1929 led to catastrophe within 18 months. This is not prophecy. It is pattern recognition. Once seen, it cannot be unseen. To understand how the pattern begins, we go back to 1920. World War I had ended. The United States emerged as a creditor for the first time. Europe owed billions to American banks. Industrial capacity, built for wartime production, now needed peacetime markets. Workers who had forged artillery shells and aircraft engines needed to make refrigerators and cars. Yet demand was unstable. Across 1920-1921, the U.S. fell into a sharp recession. Factories idled, unemployment soared, commodity prices collapsed. It was the kind of downturn that, historically, corrected excess and restored balance. Then came the turning point. The Federal Reserve, barely 7 years old, decided to stimulate aggressively. They slashed interest rates. By 1924, the Federal Reserve discount rate was just 3%. Credit became oxygen. Banks lent freely. Installment plans allowed people to buy automobiles, radios, appliances, goods that previously required years of saving. For the first time, consumption was decoupled from savings. You could have the future, right now, financed. But here is the invisible mechanism that no one understood. Cheap credit rewires human behavior. Why save when borrowing is nearly free? Why build a factory when you can buy shares that double in months? Economic incentives pivot from production to speculation, from patience to leverage. Culture itself transforms. The American dream quietly shifts, not from hard work to ownership, but from ownership to financial alchemy. By 1925, that shift was accelerating. Stock prices began to climb, not dramatically, but steadily enough to evoke curiosity. Ordinary workers, teachers, shopkeepers, farmers, asked neighbors how so many people were getting rich so quickly. And neighbors replied with the secret weapon, margin. Margin lending was the original financial weapon of mass destruction. Walk into a brokerage with $1,000, and the broker would offer to lend you $9,000 more. You could buy $10,000 of stock with only $1,000 down. If it rose 20%, you earned $2,000. Your equity instantly tripled, a 200% return without lifting a finger. The danger hid beneath that same arithmetic. A 10% decline wiped out your entire stake. A further drop meant you owed more than you had. When the broker called for more collateral, and you could not produce it, your position was sold at any price. The selling itself drove prices lower, triggering more margin calls, more forced sales, a mechanical cascade. By 1927, margin lending had exploded. Borrowed funds for stock purchases expanded from $1 billion in 1921 to over $8 billion in 1929, an 800% increase. But the raw number masks the true danger. That $8 billion equaled about 8% of UP's GDP. Imagine if today, when S GDP is about 28 trillion, there were 2.2 trillion in margin loans. That is the scale we are dealing with. It got worse. Investors borrowed from brokers. Brokers borrowed from banks. Banks borrowed from other banks. Some banks borrowed from non-bank financial pools, which borrowed from private capital. The system became a tower of debt, each layer trusting the one below it to function flawlessly. Nothing illustrates the insanity like the call, money market. This was where brokers secured the funds they loaned to margin customers. In 1928 and early 1929, call money rates spiked to 12%, 15%, even 20% for overnight loans. Brokers were willing to pay it because speculators would pay even more, and speculators tolerated it because stocks were returning 30%, 40%, 50% a year. This was not investment. It was a feedback loop. Borrow at any cost because the price will rise. Corporations joined the frenzy. Manufacturers with cash reserves asked why their money should sit idle, earning 3% when they could lend it at 12%. They diverted capital away from inventories, new equipment, wages toward financing speculation. They became shadow banks. Worse, they performed no real risk assessment. Yield was everything. This was stage one. Easy credit creating synthetic prosperity. Not real growth, but a carnival of debt-fueled speculation. You can track the illusion in the data. From 1925 to 1929, the Dow Jones Industrial Average climbed from 100 to 381, a 281% increase. Corporate earnings grew maybe 30%. Dividends barely moved. The entire rise was multiple expansion. People paying more for the same dollar of earnings simply because they believed someone else would pay even more. And here lies the psychological trap. In 1925, it did not feel like madness. It felt like progress. The world was modernizing. Ford's assembly line redefined manufacturing. Radio carried news and entertainment into millions of homes. General Electric electrified a nation. Real productivity gains were happening. The prosperity was tangible. What people missed, however, was the divergence. assets were rising much faster than the economy. That gap is where danger hides, because eventually prices must reconnect with reality, and the correction is never gentle. By 1927, another accelerant entered the system. The Federal Reserve watching stock markets climb, while inflation remained tame. Cut rates again, from 4% to 3%. Part of the decision came from Europe's plea. Britain and Germany, still scarred by war, needed capital and stimulus. With the world still on the gold standard, high gold, as rates pulled gold from Europe to America, choking their reserves. In the name of international cooperation, the Fed eased. It was a fatal miscalculation. Speculation turned national. Newspapers published daily market updates. Radio hosts became investment gurus. Brokerage offices filled with teachers, janitors, secretaries. New traders convinced they had discovered a permanent money machine. The culture of speculation finally met its catalyst: investment trusts. Investment trusts were the mutual funds of the era, pooled portfolios managed by professionals. In theory, they provided diversification and expertise. In practice, they became leverage factories. A trust would raise $10 million from investors, borrow another $5 million, invest $15 million in stocks, watch prices rise, then trade at a massive premium to its actual assets. Some traded at premiums of 60% or more. Even worse, trusts bought shares of other trusts, creating nested leverage, like mirrors, reflecting mirrors, each amplifying the illusion. By 1929, nearly 750 investment trusts held over $8 billion in assets, nearly equal to total margin loans. The most infamous example was Goldman Sachs Trading Corporation, a product of financial engineering so intricate that even the people selling it barely understood the risk. The system looked sophisticated, innovative, cutting edge. In reality, it was brittle, and once the first domino fell, the mathematics of leverage would do the rest. Goldman Sachs understood that the market was not just hungry for stocks, it was starving for the illusion of professional management. So when they launched the Goldman Sachs Trading Corporation in late 1928, it was not advertised as speculation. It was marketed as sophistication, a new financial vehicle for the modern age. It raised over $100 million, an astronomical sum at the time, and almost instantly its shares traded at a premium. Investors were not buying assets. They were buying prestige. If Goldman was selling it, surely Goldman knew something. The rest of the world did not. And then something even more telling happened. Goldman saw the frenzy and doubled down. In mid-1929, they introduced the Shenandoah Corporation, pulling in another enormous wave of capital. But the kicker was how these trusts invested. The first trust poured money into the second, a financial Ouroboros capital, feeding on itself. Then, barely weeks later, a third trust emerged. The Blue Ridge Corporation. Shenandoah bought into Blue Ridge. Blue Ridge held positions in the first two. Round and round the leverage loop went. The structure looked solid on promotional brochures. Diversified investments spread across America's most successful companies. In reality, it was one of the most fragile financial constructions ever assembled. Each layer was inflated by premiums, leverage, and borrowed confidence. To outsiders, it looked like a skyscraper made of marble. To insiders, It was an unstable scaffolding of debt and self-referential valuation that would collapse floor by floor the moment prices declined. But no one cared. They reviewed their account statements, saw paper profits, and congratulated themselves on their intelligence. The mania was infectious. By mid-1929, speculation was not an activity. It was a national identity. People quit their jobs to trade. Brokerage offices were packed like betting parlors. People clustered around ticker tape machines as though they were oracles of the future. Everyone was winning. So everyone believed they were geniuses. A secretary buys 100 shares of RCA at $85. 6 months later, they are worth over $400. She has not studied finance. She has not read earnings reports. She simply bought what everyone else was buying, and the market rewarded her. Why spend years building a career when markets pay more in half a year than your employer can pay in 5? This is the second stage of the pattern. Speculation replaces investment. Price becomes its own justification. Leverage is praised as wisdom rather than risk. You do not have to understand fundamentals. You only need to understand that money goes up. But here is the part of every bubble that gets ignored. The people who see it coming. Every mania has its Cassandras, and 1929 was no exception. One of them was Joseph Kennedy, perhaps the most successful speculator of the era. Kennedy did not get rich by believing markets reward virtue. He got rich by understanding human psychology. He ran stock pools, coordinated operations, where wealthy insiders secretly bid up shares to attract retail buyers. Once the crowd piled in, the insiders dumped their holdings and walked away richer. It was perfectly legal. It was the game. The famous story, whether true or not, is that Kennedy knew the party was ending when a shoeshine boy gave him stock tips. If the least financially literate members of society are trading, he reasoned, then there is no one left to buy when the big players want to sell. But the real reason was more cold-blooded. Kennedy understood the mathematics of margin and forced liquidation. When everyone is holding stocks with 10% equity, a mere 10% drop obliterates their in-tier stake. The broker issues a margin call. The investor cannot pay. The broker sells the shares at market, pushing prices lower. The selling triggers more margin calls, which trigger more selling. A chain reaction with no off switch. Once the engine starts, it consumes everyone until leverage is purged from the system. So Kennedy did not simply exit. He positioned himself to profit from collapse. He built short positions. He placed himself on the opposite side of the delusion. He was not a savior. He was a predator. And he was not alone. Bernard Baruch, one of the most influential financiers in American history, read the mood of Wall Street the way a veteran hunter reads the wind. He had lived through earlier panics. He knew that bubbles felt less like prosperity and more like hysteria, disguised as optimism. In his memoirs, Baruch would later write that by the summer of 1929, he could sense danger in the very air, a manic energy, an intoxicated confidence, a religious certainty that prices would never fall. He liquidated. He retreated to cautions and government bonds, while everyone else sprinted toward the cliff. And it was not just American elites who knew something was wrong. European capital was quietly exiting the market in August and September. British banks, veterans of centuries of bubbles, the South Sea mania of 1720, the railway bubbles of the 1840s, recognized the familiar scent of irrationality. They sold into the rally. German investors pulled back. French funds closed their American positions. The old money, the money that survives, drifted toward the exits. Even the Federal Reserve saw the fire, but failed to grasp its size. Throughout 1929, the Fed tried to cool speculation by raising rates from 5% to 6%. They warned banks. They discouraged risky lending. But the shadow system that financed speculation did not care. The call money market, overnight loans to brokers, was offering returns so high that industrial corporations, wealthy individuals, and foreign investors were effectively acting as banks. They poured cash into the vortex because the yield was irresistible. The central bank pulled the lever, but it was not connected to anything. That was the most terrifying revelation. The Federal Reserve had lost control of the credit cycle. They believed the economy obeyed their tools. It did not. Speculation had migrated outside the official system, and that shadow ecosystem was swollen with leverage. The Fed could not monitor, let alone contain. Then came the signals. Hindsight makes obvious. Corporate insiders unloaded shares throughout 1929, not token amounts, but massive liquidations. These were executives who knew their balance sheets intimately. They were not selling because business was worse. They sold because stock prices were insane. They knew the market had priced in years of impossible growth, and they told investors nothing. They filled press columns with optimism. They praised innovation and expansion while quietly cashing out. It was not technically lying. It was something colder. Truth, with the critical parts removed. Wall Street's trading volume surged. 4 million shares in a day. 5 million. What the public saw as enthusiasm, professionals recognized as distribution, the quiet handoff of risk from insiders to amateurs. The smart money left the table while the crowd kept drinking. And then the bull market hit its peak. Early September. The Dow touched 381, a height it would not see again for a quarter century. Stocks traded at valuations that defied arithmetic. RCA had infinite price to earnings because it paid no dividend, and no one cared. People were not buying income. They were buying hope. General Electric at 35 times earnings. General Motors at 40 times. Companies that built radios and cars were priced like companies inventing the future. But the hidden truth was this. Profits had already peaked. Industrial orders were falling. Commodity prices sliding. The real economy was cooling, while the financial world drifted further into fantasy. That divergence, the moment markets detach from the world they are supposed to reflect, is the mark of the fourth stage, a phase where prices rise not because of reality, but because everyone believes someone else will pay even more tomorrow. The justification had a name: New Era thinking. Economists claimed technology had rewritten economic laws. Productivity improvements would continue forever. Scientific management would eliminate downturns. Cars, electricity, radio, These innovations would lift corporate profits indefinitely. And the most respected economist in America, Irving Fisher of Yale, gave the world its final blessing. Stocks, he said, had reached a permanently high plateau. Irving Fisher was not a charlatan, nor a reckless gambler. He was one of the most respected economists of his era, a mathematical pioneer who understood equilibrium, interest rates, and capital formation. When he said, stock prices have reached what looks like a permanently high plateau, he did not intend to deceive anyone. He genuinely believed that the fundamentals of modern industry, technological advances, and productivity gains justified the valuations. He was wrong, but his wrongness came from conviction, not malice. If Fisher, a man who shaped economic theory, believes it, why should anyone else doubt? The newspapers amplified the sentiment. Columnists explained how America had entered a new age, an age where business cycles were tamed and wealth was boundless. Weekend magazines ran optimistic essays with titles like "Everybody Ought to Be Rich." Investment advisors mocked caution. Holding cash was old-fashioned. You were not just missing out. You were failing to participate in the greatest engine of wealth creation in human history. Even skeptics were shunned. To question stock prices was to reveal that you did not understand the modern era. This psychological shift mattered more than any balance sheet. It was not merely that prices were high, it was that high prices became their own justification. If stocks had risen 300%, that was proof they were worth it. The market, people said, was efficient. The logic loop was airtight. If prices were too high, they would fall. Since they were rising, they must be correct. Circular reasoning disguised as economic truth. It was less analysis and more theology. This mindset had shown itself before. In the mid-1920s, Florida experienced a land boom so absurd it resembled performance art. Swamp land was subdivided, sold to speculators who never saw the property, who never intended to build, who existed only to flip to the next buyer. Prices multiplied, not because of construction, not because of demand, but because of belief. Then, in 1926, the bubble burst, the dream evaporated, fortunes vanished, and lessons were available for anyone who cared to learn them. Almost no one did. The mania did not die. It simply migrated from real estate to stocks. The same magical thinking, the same immunity to risk, the same refusal to acknowledge gravity. By late 1929, owning stocks became a social marker. Cocktail parties turned into informal investment clubs. Dinner conversations revolved around hot picks. Gains were shouted. Losses were whispered or never mentioned. Ordinary people imitated the wealthy because everyone they admired seemed to be getting richer. Social proof on a mass scale. If everyone is doing it, then it must be safe. This was stage 4 of the pattern. Valuations that defy mathematics, skepticism framed as ignorance, and the sacred belief that this time is different. Then the unraveling began. October 1929 did not start with a crash. It started with a crack. On Thursday, the 24th, heavy selling pressure appeared at the open. Prices slid rapidly. Margin calls were issued by the thousands. Leverage was a silent killer. When you are leveraged, 10 to 1, a 10% drop eradicates all equity. Investors did not sell because they panicked. They sold because they had no choice. Brokers liquidated positions automatically. The panic was intensified by the technology of the era. The ticker tape was hours behind reality. Trades were happening in New York. But small investors across America received information with a 2-hour delay, trapped in an informational fog. Were they ruined or merely bruised? No one knew. Fear filled the gap. That afternoon, the titans of finance attempted a heroic intervention. Thomas Lamont of J.P. Morgan, Albert Wiggin of Chase National Bank, Charles Mitchell of National City Bank. Men whose names embodied power met in Morgan's offices and announced a consortium to stabilize markets. They would be buyers of last resort. For a few hours, it worked. Stocks rallied. Newspaper headlines celebrated the rescue. Friday passed calmly. Saturday, markets were closed, and the public was reassured that the crisis was over. It was not. Across the weekend, margin calls arrived by mail. Many investors, already fully leveraged, could not meet them. When markets opened Monday, selling was immediate and violent. The Dow plunged 13% in a single day. Record volume. A tidal wave of forced liquidation. Then came Tuesday. The opening bell delivered a flood of sell orders so overwhelming that there were almost no buyers on the other side. 16 million shares traded a record that would stand for decades. By the end of those 2 days, the market had lost a quarter of its value. That collapse was only the prelude. Over the next 3 years, the Dow would fall from 381 to 41, an 89% decline. The greatest bull market in history became the greatest bear market ever recorded. The investment trusts, the leverage engines that magnified gains on the way up, became furnaces on the way down. Goldman Sachs Trading Corporation, launched at $100 and later trading at $326, fell to $1.75. Not a 98% decline, a 99.5% annihilation. Shenandoah and Blue Ridge, built like Russian dolls of leverage, were obliterated. Billions in paper wealth evaporated, and with it, the illusion of invincibility. This was stage Aya. The crack becomes a cascade, where mathematical selling overwhelms all buyers, where leverage unwinds with no mercy. But the crash did not create the Great Depression. It was merely the detonator. Stage 6 was the systemic cascade. Investors who were millionaires in September became bankrupt in November. Banks that had financed speculative purchases absorbed the losses when borrowers could not repay. To survive, banks cut lending. When banks cut lending, businesses couldn't buy inventory, invest, or even pay workers. Layoffs multiplied. Joblessness spread. Mortgage payments stopped. More bank failures followed. The cycle tightened like a vice. By 1930, bank failures were not occasional. They were a torrent. Depositors lost their savings because deposit insurance did not exist. Fear replaced trust. People lined up around blocks to withdraw whatever money they had before their bank collapsed. Even sound banks failed when everyone demanded their cash at once. By 1933, more than 10,000 banks were gone half the Ayut, as banking system erased. And beneath all of this operated the mechanism Fisher himself would later describe debt deflation. When asset prices fall, the real burden of debt rises. A farmer who borrowed $10,000 when wheat was high suddenly faced the same nominal debt in a world where wheat prices had been cut in half. His debt effectively doubled. Scale that misery to millions of households, thousands of firms, and entire sectors. Defaults accelerated. Bank capital evaporated. Deflation fed insolvency, and insolvency fed deflation. A death spiral. By 1933, industrial production was cut in half. 1 in 4 Americans was unemployed. International trade collapsed by 2/3. This was not just an American disaster. The gold standard linked nations into a global chain reaction. When the United States fell, it dragged Europe down with it. Stage 7 was the aftermath. The long realization that the damage was permanent, that recovery would take not months, but a decade. Bread lines wound around city blocks. Hoovervilles appeared across the country, makeshift shanty towns built by people who had once lived comfortably. Faith in markets dissolved. Faith in capitalism wavered. Political consequences followed. Economic desperation in Germany opened the door to Hitler. In America, Franklin Roosevelt swept into power and launched the New Deal, not as ideology, but as triage. Social Security, unemployment insurance, federal deposit insurance, securities laws, measures designed to rebuild trust and prevent collapse. Monetary policy changed forever. In 1933, Roosevelt took the United States off the domestic gold standard. The dollar was devalued. Private gold was confiscated. It was the moment capitalism admitted that the system, left to its own extremes, would destroy itself. The United States government ultimately did something unthinkable. It suspended the promise that every dollar could be redeemed for a fixed amount of gold. In practical terms, this was a default on the original terms of the money itself. The gold peg, once sacred, became a casualty of survival. Citizens were compelled to surrender their gold at a fixed price, and the government revalued it against the dollar afterward, solidifying the shift. The public understood what this meant. The ground beneath the financial world had shifted. The rules of capitalism could be rewritten if the collapse was severe enough. Only then, slowly, unevenly, did the American economy find a fragile foothold. Recovery was not a miracle, nor a sudden burst of productivity. It was a grind. Decade-long restructuring, capital controls, regulatory reform, and the slow reconstruction of trust. But the truth is harsh. Full recovery never materialized until the outbreak of World War II forced the government to mobilize the entire industrial capacity of the nation. Tanks, uniforms, bullets, ships, that scale of spending, that volume of production, succeeded where monetary policy and reform had failed. It took a global war to end a domestic depression. That is stage 7, the aftermath. A new equilibrium emerges, but it is scarred and diminished. An entire generation has fewer assets, less optimism, a different relationship with risk. The previous economic order dies. The political landscape rewrites itself. Leaders rise who would have been unthinkable in calmer eras. People no longer debate theories. They demand solutions. Now, here is the uncomfortable truth. We do not study 1929 as a museum exhibit. We study it as a warning, a prologue written in the blood of previous generations. The same architecture of collapse has unfolded multiple times in human history, and nearly every component of that architecture exists in our present environment. Stage 1. Artificially cheap credit. After the 2008 crisis, interest rates in the United States hovered near zero. Quantitative easing created oceans of liquidity. It was not limited to the euros. Europe pushed below zero. Japan ran negative rates like a laboratory experiment. Central banks turned the financial system into a perpetual motion machine powered by free money. Corporate debt exploded, not to build factories or develop new lines of production, but largely to repurchase shares and enrich shareholders. None of this was investment. It was accounting alchemy. Households followed the same path. Credit card debt crossed $1 trillion. Student loans soared toward $2 trillion. Americans mortgaged their futures at a scale that dwarfed pre-2008 levels. Globally, debt ballooned beyond $300 trillion, triple the world's economic output. In 1929, credit was reckless. Today, it is cosmic. Stage 1 is not simply complete. It has been surpassed. Stage 2. Speculation. Replacing investment. The last 5 years read like satire. Meme stocks traded like lottery tickets. The NFTs, infinitely replicable digital images, sold for millions. SPACs raised billions without identifying what they would buy. Crypto tokens, with no revenue, no intrinsic value, no cash flow, achieved trillion-dollar valuations on pure belief. High-frequency traders skimmed fractions of pennies, thousands of times per second. Retail investors learned options trading from influencer clips and TikTok tutorials. The stock market became a social performance, not a capital allocation mechanism. This was not capitalism. It was a casino wrapped in Silicon Valley rhetoric. Stage 2 complete. Stage 3. The exit of the informed. Warren Buffett accumulated a cash reserve larger than at any moment in Berkshire Hathaway's history. He did not buy the dip. He waited. Corporate insiders sold shares while praising their own companies publicly. Hedge funds quietly placed bets against the markets. Central banks purchased gold rather than treasuries. Foreign capital peeled away from U.S. assets. The people closest to the furnace were walking backward toward the door. Stage 3. Complete. Stage 4. Delusions, masquerading as innovation. A familiar refrain returned. This time is different. In 1999, it was the internet. In 2006, it was housing. In 2024, and beyond, it became artificial intelligence. Loss-making companies commanded valuations in the hundreds of billions. Tesla's value exceeded that of entire industries, despite selling a fraction of the vehicles. Justification became elastic. Perhaps it was not a car company. Perhaps it was a software company, an energy company, an AI company. Whatever. Narrative preserved the share price. Crypto tokens became faith objects. Skeptics were dismissed as dinosaurs who did not understand the future. The same religious optimism that fueled the Florida land boom of the 1920s and the dot-com bubble of 1999 re-emerged with new branding. Stage 4. Complete. Which brings us to now, the pre-collapse moment. Stage 5. The crack that has not yet erupted, but sits ready beneath the surface. Markets today exist in the same mathematical configuration as 1929. Leverage. Piled on leverage. Borrowed wealth stacked upon borrowed expectations. Balance sheets that only function while prices rise. Margin-linked portfolios held by hedge funds, pension funds, and retail traders alike. In 1929, margin calls were mailed. They were literal envelopes. In our era, they are automated scripts. 1% down, margin call. 3% down, forced liquidation. No human decision, no breathing room. No mercy. When fear arrives, trades will be executed faster than understanding. Order books will evaporate. Circuit breakers will delay the inevitable by minutes, not weeks. And when trading resumes, bid-ask spreads will not resemble pricing. They will resemble surrender. This is how cascades begin. 1,000 small failures detonating in microseconds, multiplying into systemic collapse. Stages 6 and 7 will follow with the same brutal inevitability they have followed every historical mania. Look backward. Japan in 1990, global housing in 2008, crypto in 2022. Each collapse was presented as unpredictable as a black swan. But to anyone who studies leverage mathematically, they are not unpredictable. They are guaranteed outcomes. Here is the reality. Most people never learn. Crashes are not random. They are mechanical. When credit lines outgrow income streams, when speculation replaces productive investment, when belief substitutes for valuation, the system moves beyond instability. It becomes mathematically unsustainable. It cannot adjust gradually. It must break. We repeat history, not because we are ignorant, but because we are human. We convince ourselves that technology makes us immune to consequences. We tell ourselves that more data, more models, more code will tame the same beast that destroyed our grandparents. We forget that every algorithm is written by someone who believes the future will resemble the past. And so the wheel turns. We stand in stage 5, waiting for the crack. When it comes, it will not care about optimism, or narratives, or innovation. It will punish leverage, not hope. The few who prepared will endure. The many who did not will search for someone to blame. Because that is the final lesson of every collapse. The crash is never your fault. But surviving it, that is on you.